Good evening, everyone. Good evening. Today is Tuesday, July the 13th, 2021. And this is today's edition of Real Estate Note Talk. We come on here on Tuesdays at 7:30 p.m. Eastern Standard Time just to talk about the note industry, the note investing strategy. We try to focus on different topics within real estate note investing, and we just try to focus on them, give some information. Hopefully, the information makes sense, and you'd be more, interested in learning more about investing in notes. I feel that there's an opportunity now. It's going to be even more of an opportunity coming up at the end of this year, going into next year. So we'd like to get this information out and have people, take advantage of this opportunity. So today we're talking about risk and payment history. So we're going to focus on those two things and kind of, talk to you a little bit about that. So so when it comes to risk, why is risk so important? Obviously, that should be your number one focus when you're investing in anything, not just real estate notes, but anything that you want to invest your money in. You have to think about the risk. And when it comes to note investing, when we say risk, it means your investment to value. How much money am I paying for compared to what this asset is worth? Now, with notes, you buy the payment stream, the IOU, you buy the note as well as the security agreement. The security agreement is what you would like to value. What is that collateral in that security agreement? Um, in notes, it is the actual property. So we have to find out what is this property worth. And there are a number of different ways to do that. You can go online. You have Zillow, Realtor.com. What other website do you have? Trulia. You have a lot of these types of websites that will, once you put in the address, it'll give you an idea of what they say the property is worth. And a lot of times they are within the ballpark. They'll give you a good range, probably within 10 to 20% of the actual value. If you look at 3 or 4 different of the online values, and they are all, close in range, 100,000, 110, 105, 107. You know that this property most likely is between 100 and $110,000. And you have to be confident knowing what the asset is worth when we're investing in notes. We have to make sure that we have a really good sense of what that value is. Now, if you see a bigger range, you see 100,000, 125,000, 140, and then you see another one for 85,000. We're not so confident with the online opinion of what the value is. So we have to think to ourselves, we need to get, drill down more on its value, and we can do that in a lot of different ways. The way that we can do it is by contacting the local realtor in the area who knows the area. A lot of times they can look it up on their MLS system, see what things are selling for. Obviously, they may work that particular area, so they could give you a better sense of what a 2 bedroom, a 3 bedroom, 2 bath house sells for in XYZ state, and city, and area. And you probably can go off of that. If you look at that and their numbers is maybe somewhere along or somewhere in the range of one of the numbers that you saw online, you probably can feel confident that the property is worth what they're telling you. Now, a lot of times we don't know the interior condition, which is going to play a part, but we like to get a ballpark figure of what it's worth. And if you can do that, obviously doing it with a lot of free resources or just reaching out to somebody local who's probably not going to charge you, that's even better. Um, or what you can do is you can order a BPO. That's a broker's price opinion. Again, that's a local agent or a broker in that particular area is going to put together a more formal report for you. And they're going to give you listed comps, sold comps, and comps that are under contract. And this will give you, the actual idea, a physical document that'll tell you what this asset is worth. And you'll have to pay for that, but because of the expense of it, which is like $75 or $100, it's worth to put up $75 or $100 before you pay $25,000, $40,000 for a note. If you lose 75 or 100, it's a lot better than, obviously losing 25, 30, $40,000 or buying something wrong with that amount of money. So once you get that back, usually takes probably 3 to 5 days, maybe even less, to get that report back. You look at it, you say, okay, it's worth $100,000. So now I know that my bid for this property or the range that I want to purchase it in is X, Y, Z. But getting down, understanding what my risk in this whole deal is the main thing that you want to do. If you can get that right, a lot of the other things can kind of fall into place and you can kind of work through. But if you get the value wrong, it may take a little bit more to work your way out of this, but you want to start there. So, that's what we do. We make sure that we have the value and we have proof of the value. And even if you're confident, on the online in the beginning, as you're getting into note investing, you still probably want to just make sure and get the BPO, but you don't have to order it right away. You can order it when you're closer to making a buying decision, just to reconfirm. Obviously, once you start doing this a few times, you may have a better grip on determining value and feeling more confident in it, where you don't have to necessarily pay for that service. So, getting that is very important. You have to understand your investment to the value, and then also your investment to the unpaid balance. Obviously, we don't want to pay more for a note where the unpaid balance is more than or less than what we're paying for. That wouldn't make a whole lot of sense to do that, because if that person doesn't keep that property to the end of the loan, you are essentially going to lose money, because if it pays off early, they owe less than what you purchased for the note. Let's say you purchased it at $25,000 and there's only $20,000 left on the unpaid balance, and after you buy it, they take advantage of these great rates and they refinance. Now, you're only going to get $20,000 plus any payments that you collected. So you're taking too much of a risk by doing that, because you could, obviously not make as much money as you put into it. Now, on the other hand, if you did pay more and it took them a longer time to pay off that $20,000 balance because of the payments that you're collecting over time, it could work out, but it's really not worth taking that risk. It doesn't make any sense, because you have to always think about worst case scenario. Worst case scenario is if this pays off forever. But we can pay a higher percentage of investment to unpaid balance than we can to our investment to value. The reason why we can pay more of the unpaid balance, because we're going to be collecting those payments, and even if it does pay off and we're at 90% of the unpaid balance, we're still owed that other 10%. So we're still going to get all the money that we put into it plus 10% more, whatever that payoff amount happens to be. You can go up to 95%. So worst case scenario, if it does pay off early, you're going to get all your money back and just a little bit more on top of that. But you don't want to do that when it comes to investment to value, because if worst case scenario is that we have to take back the property and we're in it for 90%, 95 cents on the dollar, some of our exit strategy, we don't have the ability to kind of take the property back and be able to sell it right away. And you can do some other things maybe in that instance, but we really want to stay away from getting that high amount of risk by purchasing at that type of percentage, 90-95% of the value of the property. It will limit us to what it is that we can do in terms of exit strategy. You'll have to hold on to the property either by renting it or creating a new note. And what if certain other factors in that particular market prevent you from getting a good rental value? So or getting the value that you're looking at when writing a note. Maybe the job market there is bad or something like that. So we have to be careful in terms of our investment to value. We want to make sure that we had a good ratio, so worst case scenario, we'll be able to recoup on our investment. And then when we talk about the risk too, we want to look at the potential yield. So, what am I buying? And if I get all of these 12 payments, what is my yield going to be compared to my investment? It's going to be 8%, 10%, 9%, 7%. So we it's only potential yield because we don't know. We're hoping that this person's going to make 12 payments and consistently pay, but what if they only make 10? We don't know the yield until after the first year, and then in the second year it could change too. What if they only make 11 payments or something like that? So the yield can give you an idea, but you don't know exactly what it's going to be at the end of the year. So that's again why we have to make sure that on the risk side that we are purchasing, at a good price. Because we could be expecting 12% yield, but if we don't get all the payments, are we okay if we only, had 7 or 8? It still may be a decent return, but we'll have to look at that at the end of the year. But we want to make sure that we're in a good position when we buy this thing. So, and then lastly, we're going to just talk about the payment history. And what we try to focus on is the pattern and how long have they been paying. You probably want to look at the last 12 to maybe 18 to 24 months to kind of develop a pattern. That's probably going to continue when you purchase the note. So that'll give you an idea. Are they consistently paying over this last year and a half to 2 years or a year? That's most likely going to continue. And then how long have they been paying for? I mean, if they've been, obviously paying the same way for 5 years or more, we have a pretty good indication that they're going to continue to do that. But we want to take that smaller bite size of a year, 18 months, up to 2 years even, for us to get an idea of the pattern of how these particular people pay. And then sometimes you can see that, for 6 months, through these months here that we're in right now, from maybe April, May, June, July, August, September, they're good. But then when they get into the fall and winter months, maybe you see a little hiccup. That'll tell you something that you can expect around that particular time. Maybe they have some type of job or employment that slows down in those months. They tend to make up the payments, but you know that you may miss a payment here or there and may have to wait and everything like that. And waiting on payments is not necessarily a bad thing because there are late fees, and that will add again to your overall yield because you have to collect the late fees. So, these things are very important when we're looking at and doing our due diligence is the risk, and then looking at obviously the payment history and seeing how long they've been paying and what type of pattern they've been paying. This will give us an indication of who we're dealing with and what we can expect. And then obviously the risk just protects your investment, and you always want to do that as an investor, making sure that you're in a good position. So that's what we wanted to cover for tonight. Again, we're not here too long. We're usually somewhere around 20 minutes. Just giving you some quick tips in terms of the real estate note industry and things to think about. If you're watching the replay of this, if you could share and like and share, we'd appreciate it. You can subscribe to the YouTube channel, Abundant Capital Group. You can follow me here on Facebook at Abundant Capital Group. This will be posted there. But there are a bunch of videos on the YouTube channel, as well as the Instagram has some of those videos as well. You can always go in there and look at the stuff that we did in the past. And we consistently try to put out content on Tuesday nights for the next few weeks. We usually do Monday, but because of an obligation, I'm not available for Mondays for the next few weeks. So we're doing this Tuesday at 7:30, and then we're also back on Thursday at 7:30, and we're talking about self-directed IRAs, how to use your IRA to invest in real estate or real estate notes. So hopefully, you can get something out of that if you are watching the replay. But if you have any questions or anything, my telephone number is 973-475-8488, or you can reach me at acg@abundantcapitalgroup.com. So with that being said, everybody have a good night, and we'll see you back here on Thursday at 7:30. Have a good one.